Right, let me kick off with a scalping strategy as part of our day trading lecture, what it is that some of the traders do to reach 100 trades or more. So let's just look into specifics for this. Some of them we noted were trading up to 200 trades in a day in actual fact. They would tend to have about 5 trades per product in an hour. So you can see how it lines up, because if they're only looking at 5 products, then you can work out, given how many hours there would be in the trading day they would be trading on these 5, and therefore they're going quite heftily in terms of the number of trades. 80% of the trades lasted for about 5 minutes to 2 hours. So very often they might just be trading, because they're scalping, and by scalping I mean a little bit, they might just be trading on the 1 minute chart and getting in and out very, very quickly. They also, with the scalpers, managed about 80% win rate. So how did they do that? As you can imagine from everything I've said in this lecture series so far, if you're getting an 80% win rate, the profits you're making must be very small on your wins. And as you'd expect, they were holding back on some of the losses. Well, how does that tie in with our overall philosophy, which is to let the winners run and cut the losses short? What a lot of the scalpers were doing were reversing that. If they were reversing that and cutting their profits short and letting some of their letting some of their losers run, how are they overall still profitable? How does that tie in with everything that I've taught you so far? Well, let's go in and have a look. They had win targets of about 3 to 5 pips. That's all they were trying to get, 3 to 5 points on any given trade. So they were looking to make very small gains. They added to the winners if the price was moving sharply in their favor. So they were watching price charts quite a lot, rather than just leaving passive orders, though sometimes some of the ones we spoke to would enter a trade, leave orders to take a profit and to stop loss, and just leave those trades to come to fruition by themselves. But when the winners were in there, were rising sharply, so they got into something, they would add to those positions. Some of them would add to losers up to a maximum of 3 additional positions. So how does that tie with everything we've said, which is we don't let losers run, we don't add to losing positions, we actually cut losers short. This is a very specific strategy. This is scalping. And I'll show you in a second why the mathematics still worked for them. And what they did also was, because they were trading very small sizes, even if they added to the losers up to a maximum of 3 additional positions, that still only equaled a total then of 2% of their overall trade size. Now, the bet size tended to be 0.1% of their account size, so $20 per point. If they were trading $20,000, so every pip that moved, they'd have $20. If they planned to add to losers, then they'd make that even smaller. And if they planned to add 3 additional positions, they would make it a third of that. The stop loss, if 3 times was the winning target, so whatever the winning target was, the stop loss, they would put as 3 times that. So if the winning target was to make 5 pips or 5 points, their stop loss would be 15. Now, that's the exact opposite of everything that I've taught so far. So don't panic, don't worry. This is a very specific scalping strategy, and you'll see that it can still work. They always tended to trade in direction of the trend or a pullback, and I'll show you this in a second. And the popular products tended to be the most liquid: gold, indices, and currency. So let's delve into some of this in a lot more detail now. The theory behind all of this is that the market moves in short, sharp amounts. So if they capture many small profits with small moves, then when it moves fast in their favor, they can quickly add to their position. And as soon as it slows, they would look to get out at a profit as well. If they had a loss, they added to it to reduce their average entry price, and on the basis that the market will revert back to the overall trend. And as I said, if they intended to add to losers, then they made sure that the risk per position was even smaller than it would be otherwise. So let's do some maths on all of this, make sure it all works. 8 winning trades out of 10 at an average of 5 pips would be a 40 pip profit. 2 losing trades out of 10 at 15 pips is a 30 pip loss. Remember, some of those which initially were losers would become winners and so on. But this is after all the maths is done. Their net profit, therefore, was 10 pips out of every 10 trades. So if you were doing $20 bet per pip, that's a $200 profit per 10 trades. 2 trades per hour. Per product, for example, just as an example, across 5 products equals 10 trades per hour. 100 trades, therefore, per day. That will work out at $2,000. Now, of course, that's an extreme example. Most of us will not have any ambition to be sitting in front of a computer screen for so many hours a day, or to do actually so many products, and indeed so many trades. So if we did 1/10 of that, that's $200 in a day, and so on and so forth. You can sort of work out the mathematics behind this. But again, with the scalping strategy, let's just still delve into it in a lot more detail. We've got to be a bit cautious here. Assume 10% of that whilst you learn and make errors. So let's not say $2,000, let's say $200. To increase profits, you'd need to have a larger account size and a commensurate bet size. Do not just bet larger amounts with a small account size, and you may need to observe more products. You are not a machine. So be very careful thinking, oh, well, the maths works, so I'll do it. Remember the 10 rules we came up with. What might work mathematically doesn't necessarily work emotionally. The examples I'm giving you are with very experienced traders, and it's an average. Sometimes they would do a lot better. Sometimes they might do worse. So the issue also then arises, how do we know when to enter the trade? First method that the scalpers used was to follow the trend. Very simple. They would just see the direction in which, on, say, a 1-minute chart, the price was moving, and they just traded in its direction and scalped. They took very small amounts, so they didn't have to worry too much about reversals. Okay? And you can see sometimes the trends can be quite long-lasting. And in a trend like I want to show you on the screen here, they might get in and out several times during the course of that trend, only because every time they see a profit, they take it. Every time they might turn something into a loss, they might just get out of that. And so they might be trading this trend. Now you might think, well, if they just bought and sold, they would have been fine. That's true, but they're scalpers. Remember, they're too afraid to hold in for the long term. The second method that they would typically use would be the pullback. I say I do use these strategies myself. Now, the pullback, okay? Now here, the first thing is you draw a line to represent the average price for let's say the last 9 to 12 hours, okay? The second thing you do is you try and pick the line such that the market has traded as often above the line as below it. This is basically your average around which it's been trading, and you expect pullbacks to the line if the price goes too far above it and too far below it. So if the market started dropping significantly beneath it, our traders would start expecting a pullback at some stage, and then they'd expect to exit as the price approached the line. Now, the line sometimes might be diagonal because there's an upward trend around which things are moving. How do you in any event know the trend? Well, the first thing you can do is to look at the charts, and that gives you a good idea of the trend. And also you can just look at the prices. Once you get very competent, more advanced, you'll just be able to just trade off the prices alone because you'll remember the numbers and you'll say, right, okay, it's clearly moving fast in this direction or otherwise. The thing you've got to remember with the pullback is oftentimes it takes a lot of courage, because if something's falling sharply in this direction, the temptation is to trade in that direction. And very often the scalpers will combine method 1 and method 2. They will trade in the direction and scalp their profits, and they may well at the very same time take reverse positions as well and go long And some brokers will allow you to have simultaneous opposing positions open at the same time, so shorts and longs at the same time. So what the scalpers were doing was they'd start opening a load of short positions and counter them with long positions at the same time. Their shorts would start making profits, and then their longs would take a little bit longer. So they're trading essentially across two time frames. What they were doing is they were trading in the direction of the trend for the most immediate time frame and going long against the trend and back to the mean reversion line. So we call this the average reversion line, the mean reversion line, for the slightly longer term period. And you can see, as an investor, you've probably already done that very often, but subconsciously you've traded in one direction for the short term and then thought, well, actually, longer term, I like this anyway, even though the trade might not initially have immediately come to fruition. So imagine if this is falling, you're making profits on your shorts and you're losing on your longs, but you're saying, I don't mind losing on my longs because longer term, I know this will pull back to the average. Of course, we'll monitor our stop losses on both accounts according to the rules we've already shown. Let me talk, therefore, of method 3 that the scalpers use, which is a straightforward breakout. Go long if it breaks above the upper channel, go short if the price breaks below the lower channel band. Now, what I'm going to do as we go forward is show you how to place orders so you don't have to just keep watching the screen all the time and how to do all this. When prices trade in a channel like this, very often when they break out in one direction, they break out quite sharply, and that's a scalping opportunity. Equally, what scalpers would do, remember one thing I said, is they would add new positions as the trade moves in their favor. So they'd add a new position. I've written at point 1, I've drawn the arrows, add another position because the price is moving very quickly upwards, exit the additional position because the price has started falling. Then at point 4, add another position because it looks like it's resuming. And at point 5, add another position because the price is clearly moving up and sharply. So you can see how you're doing quite a lot of trades. That's just 5 positions, 5 trades in a very short space of time. And you can clearly see how that happens, that we get to that total of 200 trades in a day when you're trading this quickly. And remember, you can keep adding those positions because you're always trading at a small size until you find that trend. What we'll do as we go forward is to look at other tactics, strategies, and order types to make scalping profitable and successful for us.